Is the market overreacting to the non-farm payroll number? Frank, let's start with you.
No, I don't think they are. I think this week's rather a quiet number for economic data coming out. So everyone was looking at these job numbers, especially in the US. And it's an indicative number of what's happening to the real economy. So not the money side of the economy. Are we really growing? Are we creating jobs? And the answer is yes, but much less than, far less than we were expecting. The market consensus was for 536,000 jobs, of which we sort of calculated 411, 420 would probably be census data, which are temporary jobs. So the real jobs on top of that came to 100 and something. That figure turned out to be only 41,000 jobs, much lower than expectation. And this is sort of, the message it sends is that the market is not confident about the recovery in the US, and that's just added to the doom and gloom that we're experiencing in Europe.
If the market's not confident about a recovery in the US, how confident can we be of a recovery or a continued recovery in South Africa, given the fact that our unemployment rate is at five-year high, sitting at 25.2% at the moment?
Absolutely, and if you take in the so-called discouraged job seekers, that pushes us up to 34-odd%, and there are some analysts like Bureau for Market Research say it's as high as 40%. 4 out of 10 people in the workforce without a job, which is 25% is the highest in the world anyway. That's in the formal market. South Africa hugely dependent over the last, over the last 16 years since the fully democratic elections were held, hugely dependent on the rest of the world. Its growth has paralleled the rest of the world to an uncanny extent. So if the world growth stops, it will affect South Africa big time.
Bridgette, euro dollar, 120.32 a short while ago, and I'm sure we're very close to key technical levels on the euro dollar. Hungary is in the headlines, so we've got pressure on the euro. Can you take us through what is happening in light of all the volatility out there?
Well, you're obviously having a lot of fallout from the sovereign default issue. We've passed the Greek debacle, but now you're talking about the likes of Hungary, you're talking about Turkey, you're having comments out of the French Prime Minister saying that they want the euro at par. All these kind of comments create that continued uncertainty in the market, which is very, very negative, specifically in the eurozone. I think what you're starting to see is this risk aversion. As much as we've seen a little bit of risk back on, we've seen it flat out just go back into the non-risky deemed assets like your German bonds, like your US assets. So those kind of moves we can expect to continue. Unfortunately, what we're seeing is the contagion in the eurozone to the effect of almost 10% since the beginning of May, which is quite significant. If you think that the rand has lost significant ground, it's also only lost 10%. So when you're looking at it in terms of the depth of the European market versus what happens in South Africa, the losses that we've seen in that zone have been very, very significant. That being said, though, what do they really do other than look for a euro at par to boost their export sector? So the situation is becoming quite dire in terms of the fact that there's a huge amount of contagion. That's the concern for the market. What does the contagion look like in terms of those peripheral zones into the eurozone that is already under unbelievable amount of pressure because it's so fragile?
And just on the equity front, is anyone going to be wanting to be caught long as we go into the weekend?
Well, as it stands, I mean, any form of risky asset is being unbundled. In fact, if we see even in South Africa, our bonds themselves were sold off today, which, you know, with the rand being at these levels, you could expect a portion of that. But I also think that what you're starting to see is a little bit of unwinding of those high yields, and that I think is going to continue across the board. The market is very, very jittery and very uncertain. This job data that we saw out today, I mean, you're looking at people losing hope in the employment sector, losing hope in the labour market. That's a big concern. The other thing is that we really do need to start seeing a bottoming out in terms of unemployment and a significant turnaround in order for us to maintain the kind of growth curve that we were looking for. So, you know, I think the market's starting to feel pessimistic, and we're looking towards the US data for some form of optimism, and that has not played forth in terms of the non-farm payroll figures today. So all the positive data that we've seen has been almost
wiped off the board, so to speak. Can we not draw some comfort from the fact that the unemployment rate did improve to 9.7% for the month of May, off the April level of 9.9%?
So, well, let's look at what happened to the numbers. So both the denominator and the numerator changed. In other words, the size of the number of labourers in the US, the labor force number also decreased. So what you got there was...
so we can't read anything into that 9.7%
no,
is what you're saying.
322,000 people did not apply for labor.
Left the labor force. And I think to just reiterate what was said, if you're not getting jobs, people are not spending. If you're not spending, firms are not hiring. If firms are not hiring, firms' growth prospects are affected, and that's coming through now strongly. And
the big concern in that number was we were looking for a massive, for a good increase in terms of the private sector specifically.
And we only saw 41,000 jobs.
The expectation was 180,000 and we saw 40,000. That is significantly lower than what the expectation was. So yes, this number is very significant in terms of what that underlying growth curve looks like in the United States, and specifically on the back of what's happening in the Eurozone and the potential for the slowdown because of the austerity measures that are definitely going to come through in the Eurozone and certainly in the UK. The outlook for growth has started to slow down very significantly.
We don't want to be too negative though, Diana. Is there some positivity out there?
I don't see too much at the moment.
I'm hoping you're going to jump to the fore with some positivity.
Well, I suppose the one thing to say is that all indicators at the moment are, as you were saying, volatile. And so 1 month's figures, perhaps we shouldn't base too much on that. I mean, they've been all over the place. So let's hope that this is an odd dip and
well, what about that theory, that it is volatility and we shouldn't place too much emphasis on this number?
I think because of the lack of other data coming out now and the other stuff that's happened in Europe at the moment, we've lost sight of what's happened to the trend. If we look at the first 5 months of this month and compare them to last month, we're doing a lot better. Well, US employment figures I'm referring to are much better than they were at that point in time. The US came out of recession halfway through last year, but employment has only increased marginally month on month since the beginning of this year consistently. So although the numbers are not what expected, it is the 5th month of increases in employment, but not the numbers that we needed to kickstart a US economy or have any implications for the further economy there, interest rates included.
Looking at the South African rand as that barometer of risk and seeing how violently it reacts to negativity out there. A short while ago we were at about 7.76 on the dollar rand. Where could this negativity push us to? If we see US equities selling off dramatically this evening, could we see a blowout on the local unit?
I don't think we'll see a massive blowout. I mean, the rand's behaved actually relatively well if you consider the huge volatility that we've seen offshore, specifically based on how we've seen it trade in the past. So I think from that perspective, you're unlikely to see the rand blow out to levels of 8.50 on an overnight weekend. But I think what you are likely to see is further weakness on the rand. I think that you can expect to see the Eurozone come under continued pressure as we see more and more concerns around the contagion. Obviously, the comments that come out of G20 will be very significant. Looking for potentially breaking through 120. On a trading perspective, 120 is quite significant because there's a big optionality that strikes out at 120. So that level will be protected for now. When that goes through, and more than likely it should, we're looking at 118, and our next levels are really down to sort of 112, which then open up significant upside on the rand, specifically just because of the way that the rand trades in parity with the Eurozone. So, you know, I think we must get our heads around the fact that we're not going to have the Reserve Bank intervening in the rand. The rand will probably weaken on its own, which is an outcome that we can expect. We certainly didn't expect to see the severity of the fallout that we're seeing in the Eurozone. But as it turns out, maybe that's your positive, is that the rand itself is going to weaken on the back of that, which potentially could help our export sector.
Although we had that consensus number for the non-farm payroll number at 536,000, we did have a range between 220,000 and 750,000 jobs that would be added. So certainly there isn't much consensus amongst economists. Nobody really knows where things are going.
No, absolutely. And a couple obviously in that survey didn't work in the census 400 plus figure that came in there. And I think last month's data threw them as well. The consensus forecast was for 32,000 jobs. We ended up at 65,000 jobs. So you're more than 100% wrong last month. So they were maybe sort of on the upside this month, so optimistic about what would come out this month.
Where do you think we're headed from here? This is the big, I know we're all looking for crystal balls at this stage. I'm going to give you all the opportunity to respond as we close out the program.
Well, I suppose the varying scenarios. Worst case scenario was, as certain of the colleagues here spoke tonight, the contagion spreads to Europe, pressure on the euro. Who knows if the Eurozone lasts. at some further time. The best alternative would be the pressure from Hungary is localized. The currency depreciates with respect to the rest of Europe after, I suppose, the markets see that no one really is going to be pushed under by defaults attached to Hungary. Growth, I think we're still far away from growth. We've got a lot of money still moving through this economy, but we're not seeing signs of real growth. We'll have to wait, I think, a lot longer before that comes through. They will come through jobs first.
Bridgette, to you?
Yeah, I think what we need to look for now is your eyes are going to be on what's happening in terms of the interest rates curve, specifically out of zones like Canada, New Zealand, Australia, etc., who have already started the hiking cycle. What the comments are going to come out next week from Ben Bernanke around the Beige Book, looking at hawkish comments out of the US in terms of what their interest rate cycle looks like. Unlikely to see anything out of the UK and the BOE, but still we want to hear the comments in terms of how they view their growth, how they view this austerity, and what the impact of that's going to be on growth, and then the inflation expectations. And South Africa's in the same ballgame, because we are looking at a flat rate curve with even now the possibility that we could possibly see another interest rate cut.
And then Diana, just quickly a closing thought from yourself.
Just that we've been talking mainly about the West and West's growth, and more South Africa is dependent on emerging markets like China, which has taken over to become its #1 trading partner. So if, as far as South Africa is concerned, we saw this already with the last crisis. South Africa was relatively unscathed, although it had its first recession in 17 years, but 1.8% contraction was very small compared with the rich world, the Western world. And let's wait and see if China, India, Brazil, that they keep up their demands and their growths continue.